Here's what's coming up on the Peak Financial Freedom Show with Jim and Dan.
We're able to reduce his total fees he's paying in writing down to 0.53%, which means over the next 25 years, he's projected to save over $500,000 in fees, which that either comes back to him in income or it's money that he can leave later down the road to whoever he wants to. So it was a great way then to solidify his income plan.
Lower the risk in the portfolio. You can use different strategies, and you should use different strategies as you get close to retire, so that income plan actually is going to work. Because if you lose 20, 30, or 40% of your money, your income plan is probably not going to work.
Based on how much safety and risk you want, how much liquidity you want, how much income you want, how much money you want to leave to the beneficiaries, literally your plan will design and tell us how much we should put in each one of those buckets to give you the highest probability that your objectives are actually going to be met in writing.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Welcome to this week's show.
We have 30 minutes of great information designed just for you.
Don't go anywhere. Make yourselves very comfortable because the show starts right now.
Hi, and welcome back to this week's Author's Corner. As usual, I'm here with Jim and Dan. They are best-selling authors, TV personalities, and radio talk show hosts. Guys, I have a great set of questions for today, and it's around one of your philosophies, the 3 buckets of money. And Jim, I'm going to begin with you. Why is there a need for buckets at all? Can a traditional 60-40 model of stocks and bonds be all that you need?
Well, I don't know. I guess that's a possibility, but I don't want to go through retirement with hope and luck. If you have a 60-40 portfolio, you have to understand you have a 38.52% risk factor, which means if the market goes down by 50%, you're going to lose approximately 38 to 40% of your money. And that's okay if you're 20, 30, or 40, but you have to bring that risk down significantly to have a proper retirement. And that's why we divide money up into buckets. Number one, to make it easy for the clients to understand, and number two, to make sure your plan has the best chance and the best opportunity for success.
So if you have that 60% stock, 40% bond portfolio in 2022, what in the heck really happened for the client?
Well, stocks and bonds went down at the same time. Stocks were down between 20 and 30%. Bonds were down between 20 and 30%. So if you look at that portfolio, the average consumer was down probably 20% with stocks and bonds, which if you're in retirement drawing income off your assets at the same time and you lose 20%, it doesn't feel real well.
And this is based on something that the financial industry is saying is safe.
Yeah, because aren't bonds supposed to be safe, Dan?
Well,
they're supposed to be safe,
Well,
right?
they're supposed to be, and they can be, but bonds have as much volatility on a daily basis as stocks do. And if you look at what happened to bond prices last year, as interest rates go up, bond prices go down. It seems opposite, counterintuitive, but they work exactly opposite of each other. Interest rates go up, which they did significantly. Bond prices went down significantly. When you have 30-year Treasury bonds, the safest asset in the world from the government, going down 37%, you know you have a problem.
Dan, let's talk about these 3 buckets. What are they, and what are they used for?
Sure. We use 3 buckets. Instead of using a diversified portfolio of just mutual funds that if you had that last year, you probably lost a lot of money. We use 3 buckets because we want to separate out assets into different specific asset classes that act differently from each other, because that's how you get true diversification. You don't get diversification by having 100 different stocks necessarily, because what happened last year? You lost money and you were diversified in 100 stocks. We want 3 buckets. The 3 buckets are, number 1, a liquid bucket that's just safe money like the bank. It's liquid, it's accessible, there's no fees, you're not going to earn a high rate of return, but it's fine. Then you use the second bucket, which would be money in the stock market, but we don't want full risk in the stock market. We want to use risk mitigated strategies where we use monthly rebalancing, we use stop losses. We don't want as much risk in the market. And the third bucket now will give us principal protection against all stock market losses and income guaranteed for as long as you live. So if you use 3 buckets, you can have liquidity and safety, you can have growth with some risk mitigation, and you can have 100% safety against stock market losses and income guaranteed for as long as you live. You now can create the retirement you want by using these 3 different buckets.
Yeah, what we have here is we have assets behaving completely differently. And rather than having everything in one bucket with a bunch of stocks and bonds and you hope it's going to work out, we have asset classes that are distinctively different, they behave different, they act differently, and they're there to serve a point.
Well, isn't it like having different parts in a car?
Yeah.
You have different parts in a car. Each part is meant for something.
Yeah.
You have the engine. That's going to make you go. You have the tires. That's what you drive on. You have the brakes that stop you. You have to have assets that act completely different so you can get to where you're going and make sure it's done safely.
Yeah.
So that might actually be a truly diversified portfolio that way, right? How are we going to define diversification? So let me ask you this. Is there a percentage of the portfolio that should go in each bucket? Like, how do you determine that?
Well, once you determine what needs to go in these buckets overall, and you identify all of the objectives the client want, you only put enough money in those buckets to do exactly what you want to do. But you have to determine those objectives up front, and you don't overweight, you don't underweight these buckets. You just put enough money in there to do what you need to do, and you go into the next bucket. And by doing that methodically so the clients understand what you're doing, and it's actually accomplishing their goals, they be saying, I really understand my money now.
When you can only do it by creating a full written plan, and the full written plan is based on achieving all the client's goals and objectives. The plan and the allocation will design itself, because based on how much safety and risk you want, how much liquidity you want, how much income you want, how much money you want to leave to the beneficiaries, literally your plan will design and tell us how much we should put in each one of those buckets to give you the highest probability that your objectives are actually going to be met in writing.
Dan, Jim, thanks so much. Hey, if you want more information about anything we spoke about here today, give us a call in the office at 916-452-7325 or go to our website. And don't go anywhere. We'll be right back.
Hi, I'm Jim Files, CEO Peak Financial, your local resource for retirement and investment planning, acting as fiduciaries for advisory clients. We're offering you a free, worry-free retirement roadmap, including a 15-minute initial call, a face-to-face meeting, a second opinion about your money, a customized retirement income plan, our Amazon best-selling book. You can walk away and keep it all free, no pressure, no obligation, guaranteed. There's no risk and there's no cost. Call now.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
On this week's segment of We Fix Your Money, you're going to meet Dean. He's in his early 60s. He feels like he doesn't have enough money saved, but really wants to retire. He's afraid of making financial mistakes like taking too much risk or running out of money in retirement. Now over to Dan and Jim to tell you how they helped Dean.
Thanks, Mark. We're so excited to be here for this week's hypothetical case study. And when you look at Dean, he might be a lot like you at home, especially when you're either retired or getting ready to retire, and you just don't know the answers to do you have enough saved, and can you generate enough income that will provide you the lifestyle that you always planned. So let's look at Dean. He's 61. He'd like to retire in a couple years at 63. He has a $52,000 pension, which is great, and he'll get Social Security, so he will have a good base of fixed income. He has $1.4 million of assets. He just isn't sure. He doesn't think it's enough because he's been told he needs this magic number of $2 million, etc. He's had a broker for 15 years, but the broker just says, keep saving, hopefully you'll get there, everything should be okay. He's had a lot of volatility in his portfolio. He's had some recent losses, and he wants to lower his risk, especially now knowing he's going to retire in 2 years. He doesn't want to take a chance. He's going to have a lot less than the $1.4 million in there. He thinks he's a moderate investor. He doesn't have any beneficiaries. It's just him. He'd like to retire with enough income that allows him to travel and do all the things he wants, but he feels almost embarrassed because he feels so uneducated about his money. He thinks everybody else knows more about their money than he does. And one of the things we told Dean was, you don't know any less. Everyone doesn't know that much about their money. We just have to educate you. And he wants to stop worrying about so many things about his money, like the risk, losses, his money running out. Doesn't want to think about that anymore. Doesn't want to think about paying too much in tax or fees. And he really feels, again, embarrassed that he has a lack of money knowledge, and he wants to educate himself so he can finally understand his money. And I think that's one of the key things in putting a plan together. So what we do for everyone we meet with is help educate them so they feel more confident they understand their money. In fact, we don't let you or anyone else move forward with a plan until you understand your plan and until you understand your money.
Well, the key, Dan, you identified it here, is that we need to make sure as a consumer you identify all the objectives you want your retirement money to do for you. And it's a whole process we go through. We won't get into the exercise today, but this kind of identifies some of it. So Dan, it's very important that all clients identify their objectives so we can architect a plan correctly. So in Dean's example, he is single. He had $20,000 in the bank. He had over $1.3 million invested in the markets. He had no money invested in the principal protected and lifetime income bucket. We increased his bank money to $100,000. We reduced his money in the growth bucket because we had to reduce his risk. We went down to $500,000, and we put money in the principal protected and lifetime income bucket of $800,000 because, again, we wanted to reduce the risk and increase the client's money. When we did an assessment of his plan, we used an outside third-party research company. They determined he has about a 52% risk factor, which means if the market goes down to about 50%, he's going to lose about the same as the market, which means he would lose $726,000 off his $1.38 million. And also what it would mean, Dean would need to generate a 108% rate of return to recover that 52% loss, which is substantial. It freaked Dean out when he saw this information, which happens with many, many people we deal with. The new plan, we reduced the risk to losing 7%, not 52%. We still were down, it's not us, the client still would be down $99,000, but not $726,000, so it's not risk-free. But we only need a 7.6% rate of return to make up that minus 7% loss, which was a substantial difference of where he was when he first came to us, Dan.
And this all came about based on what he stated as his goals and his objectives. We put the plan together that now allows him to meet that. So his current plan showed way too much risk. Can you imagine finding out you have 51.9% risk in your portfolio, meaning you could lose 51.9%? Everyone will want to reduce that down. They just don't know they can reduce it down to 7%, which is what we can do. And this is kind of a typical plan that we run for people. Once we did this, then we created his income assessment and calculated out his fees. So his income assessment was currently he's not taking any income out of his assets. And remember, he has no beneficiaries. He has no one to leave the money to, so he better use it for income. None of the money was sitting in guaranteed lifetime income, and none of the money created that guaranteed lifetime income. Well, we created $69,000 a year of income from his assets. $52,000 of that $69,000 is now guaranteed for as long as he lives. No matter what happens, stock market crashes, he lives to 120, his accounts don't earn anything, he goes down to zero in his accounts, he's still getting $52,000 of guaranteed lifetime income, which is awesome. And that means we only use about $800,000 to create that huge benefit for him. His current fees were 2.14%, and that wasn't that bad compared to most people. But when we enacted this plan, we were able to reduce his total fees he's paying in writing down to 0.53%, which means over the next 25 years, he's projected to save over $500,000 in fees, which that either comes back to him in income, or it's money that he can leave later down the road to whoever he wants to. So it was a great way then to solidify his income plan.
So then we got the risk down, we got the fees down, so now we had to figure out how do we generate enough after-tax income. So gross monthly income in green, we're going to generate $10,000 with the new plan. Federal and state taxes were about $2,375. Net after tax, $7,825. His budget was $5,800 for all of his spending needs. We got him excess cash flow of $2,000 a month plus above his budget, which means that was an extra $24,300 excess cash flow that Dean can spend on all kinds of things through the course of the year that come up naturally, whether you need new tires or you want to take a special vacation. That was needed in this plan to make sure we just didn't maintain the budget, but we got excess cash flow above that.
And the excess cash flow is the only thing that makes people feel comfortable. It's okay to spend some of their money during retirement. So then we did an analysis of what's going to be later down the road, and wasn't as much for his beneficiaries. It's going to be more for what if he needs long-term care, or what if he needs to use this money for other things in the future. So let's assume he earns 4% on his assets year after year. His bank account earns 1%, and his real estate appreciates by 1.5%, and he spends all the income we're giving him. That means he's going to spend about $1.4 million of income, and he spent all of it by age 85, and he'll still have, including real estate, about $3 million left of assets. So what if he needs long-term care at age 85, and he needs 5 years of care, and we have $3 million of assets? He has enough assets to pay for all the care at the highest quality he would ever need, so it puts him in a perfect position. How about the summary for him, Jim?
Well, like all of our clients, we do a full written retirement income plan, tax plan, legacy plan, fee plan, risk plan, etc. before the client invests their money. We were able to create significant guaranteed income for this client. We reduced this client's risk, reduced their fees. We were able to show this client how to manage their taxes in retirement. The client felt much smarter now about their money, which you would as also, and he now has enough money to do exactly what he wants to do for the rest of his life.
So this is a great example of how Dean could succeed. You might be able to do the same types of things to enhance your financial security throughout retirement. Mark, back to you.
Wow, what great results from a great plan. Your situation may not be exactly like Dean's. You may be married or retired, but you can see how planning can help you attain your goals and alleviate some of the worries about money. If this is something you'd like help with, give us a call right now. Pick up the phone, 916-452-7325, or visit our website. Now stay tuned for a great complimentary offer.
Hi, I'm Dan Ahmed, president of Peak Financial, your local resource for retirement and investment planning, acting as fiduciaries for advisory clients. If you're a Northern California retiree or pre-retiree and worried about running out of money in retirement and how to create dependable income to replace your paychecks so they last for as long as you live, we have a great free offer for you. Our typical clients have $1 million to $5 million of retirement assets, but we can help you if you saved at least $500,000. We're offering you a free, worry-free retirement roadmap that includes a 15-minute initial call, a face-to-face meeting, a second opinion about your money, a customized retirement income plan, our Amazon best-selling book. You can walk away and keep it all for free. No pressure, no obligation, guaranteed. It's time to stop worrying about your money. Don't wait. Call the phone number on the screen or go to our website to claim your free offer. You have nothing to lose, there's no pressure, there's no risk, and there's no cost. Call now.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Welcome back to the program. Now let's listen in on the Peak Financial Freedom Hour with Jim and Dan.
Jim, great to be back this week for our Peak Financial Freedom radio show. And we're going to take some questions we've heard from people in the past and answer them for the current listeners, because I think a lot of it will fit for people that are listening right now, because most people listening are either retired or pre-retired. That's kind of the people we work with. And these questions will fit, I think, that demographic. So let's look at Curtis. How about you talk about if someone's 65, they want to take out as much income from their $2 million of assets as they can, as long as it won't run out. Okay. The broker said to take out $40,000, but Curtis is saying he wants more. What can he do?
Well, if you have a conventional portfolio, that broker is probably on track. You can take out maybe 2 or 3%, and we kind of agree with that because that's maybe income. The market can go down, you could lose money, and you have to recover.
So because the asset's going up and down, you can't take as much money as what you're saying.
Exactly right. Whereby if you consider different financial instruments out there, they will actually allow you to take 4, 5, or 6% out, and they actually will give you a guarantee that you won't run out of money. So that type of plan might make a lot of sense for this type of client, Dan.
So maybe talk just real quick about that when you have an asset that's volatile that goes up and down a lot, why you can't take as much money out of that, because people think the higher rate of return you potentially get, the more income you can take out of it. Is that necessarily true?
It's exactly opposite of that, because let's assume you have $1 million and the market goes down by 50% and you're down to $500,000. If you were taking out $40,000 off that million originally, you're down significantly more. And not only are you going to possibly run out of money, but you're going to be totally stressed out during that situation, Dan.
Definitely. I think for Curtis, a quick little rule of thumb for you, being single at 65, if you had $2 million of assets, we can probably, not for sure guarantee, we can probably design an income plan that'll get you up to $100,000 of income per year from your $2 million of assets on a very, very low type of volatility portfolio. So I think it can be done.
Yep.
Let's look at the second one. How about Ferris and Ann? Haven't heard the name Ferris a long time, since Ferris Bueller's Day Off. Ferris and Ann. We don't have a pension, but we've saved $2.5 million, so they're doing a great job. We're retiring next month at age 65. Our joint Social Security will be $40,000 per year, but we need another $100,000 from our assets. Can we make it and not have to worry and not have to go back to work? Well, I think it's the same kind of scenario, just in a different way that we talked about for Curtis. I think the first thing for Ferris and Anya is we got to create an income plan, which is a big, customized portfolio of documents that we create. It's very simple when the client gets in their hand, though. There's a lot of work to do it.
Yeah.
But we show them then how their income is going to flow to them for the next 30 years. If you can imagine seeing on one page where your income comes from each source each year and the total income you're going to get, and it shows it for 30 years. If you can then show that income, how much then tax you're going to pay, what your net income is going to be, so you know each month how much you have in your hand. Isn't that what most people want these days?
That's exactly what they want. But another key to this whole income planning process that you just described, Dan, is that making sure that we don't have too much risk in the portfolio. And there's ways to lower the risk in the portfolio. You can use different strategies, and you should use different strategies as you get close to retire, so that income plan actually is going to work. Because if you lose 20, 30, or 40% of your money, your income plan is probably not going to work.
We just said it. Your income plan might not work, and people don't realize your income plan might not work if they take too much risk. I think they kind of think about it, but they don't realize it. So you need to create a plan that reduces their risk, because if they're the average type of client, they're probably taking at least 40% risk, meaning if the market market crashes 50% like '08, they probably have somewhere in a 40% risk if it's an average type of person that just has a typical portfolio. And we can't be at that level of risk. We'd like to get the risk down to closer to 5% and then create the income so that they don't have to worry about their money. And then Ferris and Ann can be worry-free in retirement. So great show this week. I think we're able to help some people listening right now because I'm sure they're thinking and worrying about these same types of things. And we always are willing to give a free second opinion to people. So if anybody out there has questions, has some needs, just give our office a call. You can sit down with us. We'll talk to you on the phone. You also can go to our website and get a lot of information, data that will help you hopefully make some better financial decisions.
Thanks, guys. That was some great information. Don't go anywhere. We'll be right back.
Hi, I'm Jim Files, CEO Peak Financial, your local resource for retirement and investment planning, acting as fiduciaries for advisory clients. We're offering you a free, worry-free retirement roadmap, including a 15-minute initial call, a face-to-face meeting, a second opinion about your money, a customized retirement income plan, our Amazon best-selling book. You can walk away and keep it all free, no pressure, no obligation, guaranteed. There's no risk and there's no cost. Call now.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
It seems like with every year that goes by, the stock market gets more volatile. Maybe it's because we're all just getting older. Today on Peak University, Dan and Jim are going to discuss how to protect some of your money from the stock market losses and still have the opportunity for competitive returns.
Thanks, Mark. I think everyone out there is looking for ways to build their wealth, but no longer willing to take excessive risk. I think that sums up what a lot of people in retirement or getting ready to retirement are trying to do with their money. So I always like to ask people, do you think we can have another crash like what happened in 2008 when the stock market dropped 53.1%? And it amazes me because a lot of people say yes, but a lot of people say no, they don't think it can happen again. And if you go back to 1929, we've had 16 times the stock market has hit a bear market and the average loss is 39.5%. So I kind of think we have high probabilities that these things are going to happen over and over again, Jim. So let's say you look at an S&P 500 example during the financial crisis of 2008. And if someone had $1 million in an IRA, maybe explain what really happened. And it might be painful when you're watching this out there because you're going to say, oh my gosh, that's exactly what happened to me. That's what I went through. But I think we have to go through things like this so people can understand they better not make that kind of mistake going forward.
Yeah, you know, that was a long time ago, right? 14 years ago, but it wasn't that long a time ago. And if you're now soon to be retired or retired, this is going to be very impactful for you. So we're taking from 2007 to 2009. That's what this graph is showing you. That's about a year and a half. You can see if you had $1 million in the stock market, the market went down approximately 7%, and you lost $70,000 of your $1 million on paper. So you were a little shocked, you were a little nervous, but you were told by your broker to stay in there, don't get out, right? Well, a few months go by and you're down again by 10%. And what's your stockbroker tell you to do, or your advisor? Stay the course, don't get out. And you're feeling very, very uncomfortable.
Well, and these are important because they're percentages, but we also now linked it and made it more personal to show you how much you actually lost, what your account value actually went down to, because that's what makes you feel the pain.
Yeah. And what I want you to think about as I go through this is what happens if this happens today while you're retired, you're soon to be retired, and you start to go through this sequence of events. Well, then the market goes down by 20%. And now you're down $200,000 of your $1 million. You're down to $800,000. Now it becomes very nerve-wracking, but you're still told the same thing. Stay in it, don't go out.
When you got to remember, how did you feel then? Because that will be how you'd feel in the future. Especially a lot of people have been very volatile in the market recently, and they might have been feeling the same type of pain now.
Then a few months later, the market's down by 30%. So now you're down $300,000 on your $1 million. If you're in retirement, you're thinking to yourself, okay, I'm pulling money out of my retirement assets for income, and I'm also down $300,000. How does that make someone feel, Dan?
It makes it very, very tough, because then on the back end of that 30% loss, now it continues to go down to 40%, and now you're down $400,000, and that just makes you feel worse because you know in your mind you're probably not going to recover. Once you lose that 40%, 30%, and you're taking income distributions, you know you're probably not going to recover. So what does that mean? You better not put yourself in this type of position where you lose this amount of money.
Yeah, and two things happen. You either make a bad financial decision, you pull your money out, now you really, really have the loss, or you stay in it and you keep on losing more money. So what do you do at this point? And then the market goes down again. It's finally down 56.78%, and this actually happened again to tens of millions of Americans back in 2007 to 2009. Now value $1 million has dropped down to $432,000, and that's before you've taken any income off of your assets.
And that's over a very short time period. That's from October 07 to March 09, about 16 months. This happened and impacted so many people in a negative way. Well, we have to have solutions for this, and we do. But Jim, maybe just go through a more recent time period from 2000 to 2022 of what happened in the S&P.
Well, on the left-hand side, you'll see the S&P 500 performance from 2000 to 2022, green positive years, red negative years. You can see if you had $1 million in the S&P 500, you started here, you ended up here as of last year, your $1 million grew to about $2.35 million if you paid no fees, if you took no money out.
So now let's look at an example. What if now you used a very conservative asset, a fixed indexed annuity that had no downside at all, but limited how much you could earn? In fact, what if you could never lose any money? So instead of having red losses, you have gold zeros, but you never could earn more than 6% per year in this example. You get this nice boring blue line that grows a little bit, never goes down, and you think, well, the red line looks a lot more exciting. It does, but when you superimpose the red on the blue, look how long it took for the red to catch up. It took until 2019 for the red to finally catch up to the blue, and then the red did go really high, but then in 2022 there's a large market loss. So now the red's really close to where the blue is, and what this is teaching us is one thing. At retirement time, the most important thing is not to get the highest rates of return, is to make sure you protect your portfolio against the highest losses. That's the single most important thing when you retire, because you will not be able to recover from a large loss if you don't have enough time to make up for that loss. Now, let's look at a quick example. What can a fixed index annuity do for us as far as protecting our assets against losses and giving us that income? So let's say we have a married couple age 65, a really good example. Income's guaranteed to be paid for as long as they both live, regardless of how long they live, regardless of your stock market losses and crashes, and regardless of how much your account earns. So let's look at now what really happens. Let's say someone has $1 million and they fund it into a fixed indexed annuity with an income rider. Their assets are completely protected against stock market losses. One of the things they're told, Jim, is that, well, you can't put your money into an annuity because you can't touch it for 10 years. What if you could put $1 million into an annuity and you could immediately take $63,000 of joint guaranteed lifetime income immediately? You have to wait 30 days and the money starts flowing to you. That would be a 6.3% guaranteed lifetime payout. That's awesome. You can't get that pretty much anywhere else. But what if you could defer it for 1 year and now your million is guaranteed to increase to $1,090,000 for income purposes, not lump sum purposes, but income, and you can now take out $69,000 simply because you deferred it for 1 year. How about you defer it for 5 years, and now your million is worth $1.45 million of guaranteed income benefit, and your income is now increased from $63,000 to $97,875. That's guaranteed for as long as you live, simply because you deferred it for 5 years, and you're getting a 9.78% guaranteed payout for as long as you live. The more you defer, the more you get, but the goal isn't to defer it forever. It's to defer it until you hit a certain income level, Jim, that allows your plan to work.
Yeah, the key is, Dan, people need to understand there's other financial instruments to integrate with a portfolio design so you can have guaranteed income, you can have growth, you can have safety. All these things can be put together in a retirement plan.
Perfect, perfect. Back to you, Mark.
Thanks, guys. When close to retirement, it makes a lot of sense to eliminate the huge losses and still be able to gain. If this is something you'd like to learn more about, hey, give us a call in the office right now. Pick up the phone, 916-452-7325, or go to our website.
You're watching the Peak Financial Freedom Show with Jim and Dan, Sacramento's retirement television.
Thank you for watching this week's show.
And if you want more information about anything we talked about here today, give us a call in the office or go to our website.
And remember, at Peak Financial Freedom Group, we fix your money.
The preceding program is sponsored by Peak Financial Freedom Group.